Hello, everyone, and welcome to our final taking stock of the year. Can you believe that 2023 has virtually come and gone? I certainly can't. It's absolutely flown. And yeah, I'm looking forward to sharing this final episode with you before we take a break and return early in the new year. But my name's Tim Lincoln, and joining me today is Kien Trinh, our head of Stock Doctor Research, and we're here to stream you all things share market. G'day, Kien. How are you going in this crazy part of the year?
It's been pretty crazy, Tim. And as you said, time has flown, and I look forward to this break that we're going to have over the next couple of weeks just to reset everything and rethink and analyze, for the year ahead, and look forward to a bit more volatility and how we manage that.
Yeah, it's certainly a challenging environment, isn't it? This year's just more on that in a moment, but it certainly has been tough, and we've had to have our thinking caps on, that's for sure. But yeah, I've loved our innovative discussions with you and your team, Kien, and obviously our funds management team and dev team to figure out ways that we can, develop products and provide services that help our members to manage these volatile environments. But as I said, more on that in a minute. But before we jump in, Kien, all of the information we share today is of a general nature and therefore should not be construed as personal advice. And all of the data, performance metrics, etc., that we also share are all of an historical nature and therefore should not be relied upon as a guide for future performance. Well, let's get cracking, Kien. And as we touched on, who would have thought that 2023 would have flown by so quickly, but also have been such a prosperous year for share market investors? This year, markets have been rocked by concerns over inflation, rising interest rates, not to mention an unexpected regional banking crisis, which led to the collapse of Credit Suisse. In addition, rising geopolitical risks between Ukraine and Russia, and now Israel and Hamas, raise concerns over supply chain disruptions and elevated oil prices. Despite this, though, Kien, the Australian share market returned around 11%, while over in the US, the S&P 500 gained a whopping 24% for the year to date. Who would have thought, Kien?
Yeah, that's incredible numbers, Tim. And this is why it's so important for us to separate facts from noise and really focus on those business fundamentals. Remember, when you're investing, don't invest on emotions, but rather concentrate on what you can control and understand. And that is the quality of those stocks within your portfolio. And these metrics, such as financial health, your return on equity or return on invested capital, profit margins, earnings quality, free cash flow, these can all be easily tracked on Stock Doctor. And over time, those high quality growth and income stocks are likely to outperform over the long term, irrespective of the market volatility.
Yeah, that's right, Kien. It's really important to maintain that disciplined approach, isn't it, relative to the type of investor you are. And but yeah, the market's certainly gone ahead leaps and bounds, but cycles always occur. Things move in cycles, and that cycle has certainly still been going against growth styled stocks and growth orientated investors, mainly due to the rapid rise in interest rates. Growth companies don't like a rising interest rate environment, and that's what we've been in. And for the calendar year to date, our star growth stocks returned around 8%, so slightly underperforming the broader All Ordinaries benchmark that we mentioned before, but outperformed the smaller ordinaries indexes. It's probably a little bit more relative to our universe of star growth stocks. And small ords only rose by about 6%. So star growth stocks sitting in the middle of the all ords and the small ords there. It was also a year where quality healthcare stocks like CSL and ResMed struggled due to concerns around competition and the emergence of weight loss drugs. Who would have thought that one either? But anyway, they did struggle because of that. But there's a lot of narrative on that particular topic that we spoke about through these forums and also in the analyst commentary for those businesses. So in light of these obstacles, Kien, star growth stocks perform relatively well, all things considered.
Yeah, that's right, Tim. And but when you're talking about investing, it's about the long term. As you can see with the chart on screen, over the last 28 years, our star growth stocks, that's in yellow, only underperformed the market, and that's in grey, in 4 years out of those 28 years. And that translates to a success rate of 86%. and an average per annum outperformance of around 9%. In addition, there has only been about 3 years that Star Growth Stocks has generated negative returns.
Yeah, no, really compelling stats. And, did the last 2 years on that graph, and it shows that they've underperformed, but that is because of that cycle shift and rising interest rate environment. And as for income investors, Kien, it's been a good year as well, with Star income stocks up around 8% for the calendar year, roughly on par with the market, which is fine because it's more of a defensive styled universe of stocks. And this comes despite interest rate hikes dampening the attractiveness of bond proxies, stocks like or sectors like the property trusts and utilities. And with the banks having a large proportion of the portfolio, the income portfolio was also hit with volatility around the US regional banking system problems earlier on in the year. So a return of around 8% with a grossed up yield of around 7%, Kien. This year is quite impressive, actually. And over the last 12 years, Star income stocks have only had one negative year for our income-styled investors. So another longer-term outcome that we're pretty proud of.
Yeah, that's incredible, Tim. And on the topic of Star stocks, though, it has certainly been a challenging year for those growth investors, as you mentioned earlier, and this chart really shows what we're talking about. You can see this with the chart on screen now, which compares growth to value investing with interest rate expectations. So bond yields here are in orange and the cash rate is gray. And the blue line represents the ratio of growth over value. So when this line is rising, growth outperforms value and vice versa. As you can see, just more recent times, growth stocks have been unable to outperform value or cyclical stocks over the last year. And this, of course, has weighed on the performance of our Star Growth stocks despite the market rally. So given that Star Growth stocks have performed positively up by about 8%, that's still quite a good return.
Yeah, another good representation of the cycle that's currently occurring, Kien. But let's now just slightly shift our focus onto financial health. And the strong rally in the market over the last 2 months suggests a degree of complacency to me amongst investors. We've begun to see financially unhealthy stocks and Bitcoin rally again, which is dangerous when we see these speckies and crypto start to really take off. For example, a lending business, Plenty Group, is in marginal financial health, and it's up by over 100% in only 1 month. Really scary stuff. Meanwhile, in the retail space, City Chicks, ASX ticker code of CCX, and Sezzle, SZL, have rallied over 60%, Ken. So a lot of speculative money flooding into these businesses. This comes despite the trend in corporate failures continuing to rise. You can see with the chart on the screen, with insolvencies for FY24 at about 35% above previous years. And despite the risks mentioned, Kien, it was a great year of opportunity for investors, with many new themes bubbling to the surface. And one of those key themes that really stood out for me was the popularity and the emergence of artificial intelligence, or AI, and also green energies such as lithium and batteries. And with our US funds, we have numerous exposures to the AI theme, with investments in companies like Alphabet, Adobe, Cadence, and Arista Networks. We also have investments in semiconductors like ASML, Latest Semi, and KLA Group.
There's some great exposures there, Tim. And but here in Australia, though, unfortunately, there are only limited opportunities to invest in healthy AI businesses because many of them are unhealthy here. However, outside of the immediate beneficiaries, we have holdings in Pro Medicus and WiseTech. Also, in recent months as well, we've noticed with the sell down across lithium stocks, they've presented wonderful opportunities for investors, especially among our Star stocks as well. We have Pilbara Minerals, Allchem, and also IGO. In fact, we have recently used this lull in the lithium market to introduce mineral resources into our portfolios, and it's been off to a great start as well, Tim.
Yeah, love to see that diversified mix of stocks, Kian. Good stuff. And the great thing about Stock Doctor is that it can help you also identify emerging opportunities before they become mainstream. You can find these by using my growth filter or income filters, and found in the stock filter section. And they're the filters with potential, which have recently been enhanced with some new criteria. So make sure you jump into those filters to find some great little emerging opportunities. Some interesting growth names that are within those filters include Sea Pearls Producer, Atlas Pearls, or ticker code ATP, Parking Technology Business, Smart Parking, APZ, and Metals and Chemicals Analyzer, XRF Scientific, that I know we've put on our insight section of Stock Doctor in both the Resource Center or on the homepage, a great little article on XRF.
Yeah, that's right. The analysts had a meeting with management. So just make sure you have a read of that. But before considering these investments, just make sure that there is enough liquidity in that stock, because when you're checking under Golden Rule 6, sometimes, the liquidity is quite low here.
And normally, Kien, we'd jump into under the microscope now, but seeing it's an end of year edition of Taking Stock, we're going to give a bit of a market outlook for next year. And so let's jump straight into that. And here in Australia, earnings growth for the market is expected to be negative, weighed down by the banks and resource sectors that you can see on the chart on the screen. However, if you exclude these sectors, growth forecasts across industrials remain positive at 8%. However, on a chart that we're about to show that represents the trend of the market's performance against the trend in analyst revisions, shows that the trend is down in regard to those earnings forecasts.
Yeah, very interesting, Tim. It's also good to see that Star Growth stocks are up, expected to generate earnings growth of around 12 to 13%. So positive for next year as well. But again, from our perspective, it is concerning to see that the US market has hit new highs while the Australian market has rallied close behind. And that's on the back of bond markets. They're pricing in and that there's an 80% chance that the Fed will pivot from rate hikes to rate cuts by May 2024. And you can see this with the chart. Interest rate cuts are reflected by the dots coming down.
Yeah, fascinating stuff, Kien. And a similar story is also playing out here in Australia with the RBA. However, we are concerned that analysts' earnings forecasts, as I mentioned just before, for FY24 are too optimistic. The chart on screen currently compares the All Ordinaries in blue with the 12-month EPS forecasts in black. Over the last 2 months, Kien, there's been a divergence between earnings revisions and share price movements. What concerns us most is that downward trend in those forecast estimates. The fact we are in an environment with persistent core inflation, higher interest rates, geopolitical turmoil, rising insolvency levels, and declining consumer business confidence, obviously those factors remain a massive concern for us. The market is currently pricing in a soft landing. But if you look at history, there are many lanes the global economy can go down whereby equities will be vulnerable. Remember, the path to a recession will look similar to that of a soft landing, in that both scenarios require a slowing economy. So while the market is celebrating weakening economic data, there may come a point where a weak economy will manifest into earnings downgrades and share price declines. That's what we're most concerned about. Until we get more clarity on the direction we are heading in, we will continue to reduce our market risks in our portfolios. As Warren Buffett wisely stated, be fearful when others are greedy and greedy when others are fearful. And I think this is a bit of a greedy market at the moment. And just as we did with Under the Microscope, Kien, and replaced it with a bit of a market outlook, we're going to do the same with Question of the Week, where we're going to replace it with some analyst ideas or their favourite stocks at this point in time for 2024. And I say at this point in time because we know that fundamentals can change, but they're their favourite ideas. So I thought it would be interesting to ask them what stocks they think would outperform in 2024.
Yes, a very good question, Tim. And first off, Dan likes RPM Global Holdings. The code's RUL. a software provider and consultancy firm within the mining industry. Although it doesn't quite meet our quant metrics under Golden Rule 2 just yet, Dan believes it's a high quality business with the company having recently provided an upgrade to their earnings. And it's a sign that there could be more software contracts to come.
Okay, interesting. And the earnings revisions are certainly strong. But here you will need to be very, very careful of relying on forecasts, given there's only one analyst covering the stock. So what's the next stock off the rank, Kien?
The next one, Tim, is quite interesting. It's the ASX Limited, ASX. Interesting one because over the last couple of years, it's been marred with write-downs and things. But Ryan's rationale behind this pick is that the softer inflation data decreases the likelihood for further rate hikes, which represents an environment that would be supportive of a recovery in volumes of IPOs and capital raisings, Tim. And we started to see a few capital raisings coming through in the market.
Okay, and now to Jason Yin. And I noticed that Jace currently likes Jumbo Interactive, ticker code JIN, both a Star income stock and Star growth stock. Jumbo is an online reseller of Australian lottery tickets and provider of lottery management software to charities and not-for-profit organisations. But the stock has been in the doldrums over the last few months, Kien, with share price under a lot of pressure.
Yeah, that's right. If you think about Jumbo, the core determinant for Jumbo's earnings is the frequency of large jackpots when the prize pool is, say, greater than 15 million. However, fewer jackpots have led to weaker investor sentiment in recent times. But the tide might be turning now with Oz Lotto jackpotting from 70 million to 90 million this week, Tim.
Okay, and aside from lottery volumes, I understand Jumbo has several growth levers, including potential M&A activity and additional contract wins with new charities for its Powered by Jumbo lottery platform business, Kien.
Yeah, that's right, Tim. That's why the growth numbers under Golden Rule 3 look so strong for Jumbo. And lastly, Charlie, he likes the drinks retailer and hotels operator Endeavour Group. EDV's the code here. Endeavour had a pretty rough year in 2023, one that was littered by governance issues, a slower trade, and also regulatory overhangs as well. But Charlie thinks 2024 should be a better year for this stock.
Okay, let's analyze this a little deeper now, Kien. And under Golden Rule 3, outlook looks like ROE and EPS may be headed for a large fall. Is this a concern for investors, Kien?
That's a great point, Tim. And but we think that decline has already been factored in its share price. Remember, Dan Murphy, it's got a strong brand equity, and the company is expected to expand its luxury portfolios, generate stronger profitability from its recent hotel renewals, and resolve its board level conflicts as well. That's why, if you haven't had a chance, you can read the Insights article that Charlie wrote on Endeavour Group as well. But given that all the analysts have given their picks, Tim, do you have any picks of your own?
I'm going to keep mine up my sleeve, Kien, and I'm going to provide a few stock tips, both growth and income, and perhaps some non-star stocks in the new year. And I'll do that in our first edition of Taking Stock that I believe is on the 2nd of February, Kien, which is obviously a Friday. So yeah, I'll do that then. But in the meantime, I'm really attracted to star stocks that have been oversold, whether they be growth or income, and have strong numbers under Golden Rule 3. And CSL is a good example of that. I know it's an old favourite, been in our stable for a long, long time, but I believe CSL is probably a good example of a stock that's been oversold. I also love names like obviously Altium, WiseTech, Pro Medicus, and I love in particular the returns that they've delivered for our members over the past 2 or 3 years. And as mentioned before too, to find some emerging opportunities, and this is a tip because there's a lot of emerging opportunities in there. You just got to make sure you dig deep into them. But have a look at my growth in income filters with potential within the stock filter. And another tip, it's a way to mitigate the concerns that we have in the market at the moment, as in regard to where we see it being a bit toppy. But what I've done is actually hedged our portfolios 30% using a BBOS Bear ETF that's Australian traded funds, so accessible by investors if they try to hedge. And you consider this particular product that, as I said, neutralizes the effects of volatility in this current period of time. And I've hedged a 30% position in all of our funds, our Aussie funds and US funds. It sure does hurt to miss out on rallies like we're currently experiencing. But in this current rally, it makes no sense to me at all. And therefore, I prefer to protect client investments by sitting on the fence for now and see how things play out over the next few months.
Yeah, that's right, Tim. Risk management is so important in this environment where rallies come with no reason at all. But talking about these stock investments as well, just a reminder that members should conduct their own due diligence to ensure that they are comfortable with those risks associated with each company.
Yeah, definitely, Kien. It's you got to dig deep, don't you? You got to do thorough due deal and make sure those companies align with your own objectives and risk tolerance levels, and that's where Stock Doctor comes to the fore. Well, that's it for this year, Kien. Great sitting down with you as always, and we don't rest though. The market remains open during these periods, so we'll keep innovating and working. But always great. Thanks for all of your efforts this year, and also the leadership you provide to our team, and also being behind the desk on taking stock most weeks. So thank you very much, mate.
Pleasure, Tim. Look forward to next year and more to come, hey, with all the volatility. But we'll also have, our analyst team still open during this Christmas period, just in case you need to ask any questions.
Yeah, that's for sure. And just to wrap things up, if you've got any family or friends that you think would like Stock Doctor, our Christmas sale is on at the moment. So jump on our website or point them to our website and direct them to Stock Doctor, and the offer is there. So great time to come on board with great discounts available. As mentioned before, we'll be back with Taking Stock on Friday, the February the 2nd. So look forward to seeing you all again then, after we enjoy a bit of a break through January. And Lincoln Live, we've had our last one for the year. It will return on Monday, the 29th of January. So mark your calendars with that one. And thanks for everyone's attendance there. It's been a great success. But in summary, and a wrap up for what we've covered today, the market is currently pricing in a soft landing, but risks of an economic contraction and rising insolvency levels remain in place. Hence why, you really need to stick in this environment to financially healthy businesses, and obviously, ideally, our star stocks to protect your portfolio if you're nervous like I am at the moment. And I've become extremely nervous, hence why I've hedged our portfolios by 30% in that BBOS ETF that you may consider if you choose to do so. I just really think that the market has got way ahead of itself at the moment, and it's simply not pricing in the risks that could occur early in 2024. But that's not pessimistic. We know volatility creates opportunity. So as soon as that plays out, if it plays out, I'll be back in snapping up some of those oversold high quality businesses. But that's it for us. Take care, everyone, and have a happy, healthy and prosperous festive season and 2024. Merry Christmas. Stay safe.